Hey, what's up YouTube? In this video, I'm going to look at the stock of JD.com and I'm going to give you guys my thoughts on their intrinsic value. So if you're new to the channel, my name's Dan. I do a lot of stock analysis on this channel. So if you like that kind of thing, hit that subscribe button to check out more. All right, let's jump into it. Alright guys, so this is JD.com. They are a Chinese online retailer, so a company a lot of people are interested in because of the huge population in China. Their potential is very high. They're currently trading at about $90 a share. Stock price has been doing very well over the past year, pretty much doubling. And they're trading at about 54 times next period's earnings. That does seem like a rich valuation, but again, they are growing a lot, so they could well be worth it. So we're going to have to analyze that more deeply. Okay guys, here is JD's balance sheet. They have a liabilities to total assets ratio of about 53%. That is not too high there. That's actually pretty low leverage. As far as long-term debt, they have almost none. The debt to assets ratio is only 3.5%. As far as any liquidity problems, they don't really have any. You know, this current ratio, this quick ratio, yes, they look a little low, but really in the retail industry, those are actually very good numbers there. A current ratio above 1 in retail is very good. By the way, guys, if you don't know any of these ratios, check them out in the description below. Interest coverage ratio, so take your profits before interest and tax and divide it by your interest expense. That's not great being at 10.4, but it's not bad either. And when you consider their earnings are expected to grow, they're doing just fine there. They got about 32% of their assets are just cash, so that's great. And they're really not very long-term asset intensive, so that is wonderful to see as well. Overall, an excellent balance sheet. Now, here's a DuPont analysis where I break the return on equity down into 3 parts. I'm looking at about 5 years worth of data, but I will say this, the company is still in the early innings, and so these previous years where they reported losses there, I don't necessarily think that's indicative of what's going to happen going forward. We kind of have to see the trend here. And the trend is more money. I mean, look at this net income margin. That tells you for every dollar of sales, how much do you make in profit. So they struggled to make a profit there, but finally they're hitting about 4.1%. That means for every dollar of sales, they get about 4.1 cents in profit. Pretty darn good for a retailer, and it's going up, so it could be even better. Asset turnover is outstanding, as it typically is for retailers. But asset turnover tells you, for every dollar of assets, how much sales you generate. For them, it's about 2.7. So for every dollar of assets, they get about $2.70 of sales. That is excellent. And of course, the equity multiplier, because they have a little bit of leverage. But that equity multiplier is really not driving their ROE. Mostly it's organic profitability, net income margin, asset turnover. So really nice company here. I can see why people are interested. Alright, so one bad thing about them not having much debt is that means they've had to issue more shares. You notice in 2011 they only had about 600 million shares outstanding. That has gone up to about 1.5 billion shares outstanding, about a 2.5 times increase. I really hate to see that, but the good news is that they're now making money and they have a good balance sheet. They're not overly leveraged. They probably don't need to make any more share issuances from this point going forward. And yes, they've had just about incredible revenue growth, $3.3 billion of revenue in 2011, going up to close to $102 billion. This has finally translated into some profitability, striking at about $1.7 billion of profit in 2019 and about $4.2 billion in the trailing 12-month period. Growth expectations going forward are also very optimistic. Next year, their earnings are supposed to grow by about 60%. After that, about 32%, then 40%, and you can see the picture here. They're expected to be earning a lot more than they currently are. I will say there's a lot of risk with this company when you look at the variability of analyst forecasts. For example, in 2021, the lowest forecast is 97 cents per share. The highest is $2.60 per share. Now, given the median is $2.21, I would weight more heavily toward the higher guy there. And that's what we typically do. We typically use the median for that reason. But it does show you that there is risk here. The pessimistic analyst could be correct. Alright guys, it's that time again. Time to use an intrinsic valuation model to get a value for JD. I'll be using the free cash flow to equity model. This model says that the price today should be equal to the present value of all the cash flows. So to estimate the cash flows for JD, I'm going to use a spreadsheet. I'm going to start with the revenue estimates and kind of walk you guys through how I arrive at my own earnings estimates. And I'll use a higher discount rate, being that the company is a growth company. It is located in China. But anyhow, I'll walk you through it. Let's get started. Alright guys, so here is the path for JD as I see it. I plugged in the median forecast here for analysts for their revenue forecast. That gives me a stream of revenues. After that, if I want to go from revenues to profits or net income, I need to know what my margins are going to be. And so 4.1 is good, but I actually predict they can increase those margins ever so slightly over time. So I'm having those margins go up by a little bit every year, kind of topping out at about 7%. That gives me net income. The next thing I need to do is subtract reinvestments, because this company will definitely be reinvesting a lot for the next couple of years. So for next year, I just said they're going to reinvest everything they make. For the year after that, I said they'll reinvest about 80% of what they make. And it kind of goes down from there as the growth rate goes down. Because companies that aren't growing don't really need to reinvest much. So as their growth declines, their reinvestment rate goes down as well. So anyhow, that gives us a stream of free cash flows to equity. Let's discount them back to present value, come up with a terminal value, and ultimately figure out what a fair price for JD stock is. Alright guys, so if I discount these cash flows back to present value using an 8.5% discount rate, I'm also going to discount this terminal value back to present value. The terminal value is just your cash flows in that terminal year, year 11, divided by the discount rate minus the perpetual growth rate. I will just assume they can grow their cash flows at 2% per year in perpetuity. That may be an underestimate. I like to be a little more conservative though. Anyhow, that gives us a total firm value of close to $200 billion here, or about $128 per share, making this a good deal right now. Now, revisiting our path here, I can see I'm being a little optimistic. Let's suppose that the margins cannot grow much more. Let's say they top out at 5%. So let's change the values here. We'll just say after you hit 5%, that's just what the margins are. And let's see how that changes the fair value. So if margins top out at 5%, the company is only worth about $97 per share. You know, given the current share price, it's still a good deal, but you don't have a lot of margin of safety under that scenario. Just something to consider. Alright guys, so here are my final thoughts on JD. First thought is that I really love their balance sheet. Very safe investment from that respect. Really not a lot of default risk there. Secondly, I really like their profitability. They have a great business model and they're growing it. So I can see why a lot of people would want to invest in the company. when you plug in the forecasted revenues, when you plug in reasonable profit margins and reasonable reinvestment rates, it looks like a good deal. So despite the fact that the share price has doubled in the past year, it's still undervalued under these calculations. That being said, it is a growth company. We do have rising interest rates. If the interest rate rises much further, it's not going to be a good deal anymore. And expectations are already very high. It's going to be hard to impress investors given what they're forecasting right now. For example, over 60% growth in earnings next year. That's a lofty expectation there. So I generally like to buy stocks when they're being neglected and not being overall loved by the market. This doesn't really fit that bill. But I could definitely see buying it because it is a good deal under the reasonable assumptions that we plugged in. It's a close one for me. Let me know what you think in the comments below. Thank you for watching.